Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at AMBA, or Amberalla Inc. AMBA develops video compression and image processing semiconductors. There's a little more to it. We're going to skip that part. Here's the barchart.com technical opinion rating for AMBA. The bar chart rating is a 48% sell with a weakening short-term outlook on maintaining the current direction. After Friday's very bearish trading, I think the bearish outlook is going to strengthen considerably. According to the prime trade select rules, a stock is in a bear trend on a monthly basis if the stock price is below the 10-period or 10-month simple moving average. The monthly chart shows that AMBA is below the moving average line, so the monthly trend in AMBA is down. Now we're going to look at the daily chart. The stock is in a bear trend on a daily basis if the 50-period or 50-day exponential moving average is below the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line crossed below the green line in March, so the daily trend in AMBA is down. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy puts if the stock price is below the lower Keltner channel line. Anywhere inside the Keltner channel or even above the Keltner channel is fine. AMBA is above the lower Keltner channel line, so AMBA is inside the sell zone. Since the trend is down, we want to buy a put. AMBA has plenty of option chains to choose from. We're going to use the July 18 chain. Right now, the July 18 options have 46 days to expiration. Here's the AMBA option chain for July 18. AMBA closed at 52.64 on Friday. That means any puts on the list from 80 to 55 are in the money. We're going to look at buying the 52.5 strike put, which is the closest strike to the current price of the stock. The bid-ask spread for the 52.5 put is 330 to 4 even. We try to enter at the midpoint, so we'll use 365 as the buy price. Our put option calculator shows that if the AMBA stock price is flat at 52.64 when the options expire, the 52.5 put would lose 100% of its value. Ouch! That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move down 1% for the put option we purchase to break even and start profiting. Now let's take a look at buying the 60 strike put to see if it qualifies for the 1% rule. Here's the put option calculator picture for the 60 put. According to the 1% rule, we want the put, to at least break even if the stock price is down 1%. The calculator picture shows that if the AMBA stock price is down 1%, the 60 put will lose 6.7% of its value. We want that to be break even or better, so the 60 put does not meet our requirements. Let's see if the 70 put will work. The bid-ask spread for the 70 put is 1580 to 1950. We try to enter near the midpoint, so we'll use 1765 as the buy price. The 70 put works. If the AMBA stock price is down 1%, the 70 put will make a 1.3% or $24 profit. That's better than break even, so the 70 put is the one we'll buy. The put option purchase calculator also shows that if the AMBA stock price decreases by 2.5%, the 70 put will make a 5.8% or $103 profit. If the AMBA stock price is down 5%, the 70 put will make a 13.3% or $234 profit. If AMBA is down 7.5% at expiration, the 70 put will make a 20.7% or $366 profit. The minus 10% and minus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice if the AMBA stock price does not make the expected move down and remains flat at expiration, the 70 put would only lose minus 1.3%, or minus $29 compared to the minus 100% or minus $365 loss for the 70 strike put that we looked at earlier. Now we want to review a put option debit spread, aka a vertical put spread. For this spread, we want to buy to open the AMBA July 18 60 strike put and sell to open the AMBA July 18 55 strike put. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 60 put for $8.45 and sell the 55 put for $4.90. $8.45 minus $4.90 equals $3.55. So the entry price or debit cost for the spread is $355. The put option spread analysis calculator picture shows that the spread will make a 40.8% or $145 profit if the AMBA stock price increases by 7.5%, remains flat, or decreases in price when the options expire. Creating the debit spread will allow us to collect a $490 cash credit to our brokerage account for the sale of the 55 put. As we said on the previous slide, this reduces the cost of entering the spread to $355. Here's a note regarding earnings reports. The next AMBA earnings report is scheduled for August 28th. Let's review the trades one more time. The first trade was a put purchase, said to buy to open the AMBA July 18 70 strike put for $1,765. We also reviewed a spread. Spread said to buy to open the AMBA July 18 60 strike put and sell to open the AMBA July 18 55 strike put at a debit of $355. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.